Well, Alan Blinder, economics professor at Princeton University and former vice chairman of the Federal Reserve, says we are experiencing deflation right now. He joins me and Kathleen right now from Princeton, New Jersey, to discuss why he says inflation is not the danger. Alan, so much to talk about with you, the Fed exit policy, but let's talk about inflation. There are folks out there who are worried. You say we shouldn't be. Why?
Well, first of all, we're in deflation now. It's not virulent deflation, and probably it'll go away because it was mainly caused by falling energy prices, which have reversed. But the very weak economy, as Paul McCulley was just saying, is going to tug inflation down. And I think it's to me, it's about a 50-50 bet whether core inflation, so this is forgetting about energy prices, dips below zero in the next year or two. That's a long way from worrying about inflation. That's worrying about deflation.
A lot of talk about the output gap, Alan, and the San Francisco Fed, John Williams, I believe, is economist there, came out with a paper last week suggesting that maybe the output gap isn't as big as, for example, the Congressional Budget Office estimates. And if the output gap isn't as big, once the economy starts recovering, even if you don't get a lot of inflation, doesn't that still maybe justify this concern among investors that you will get some higher inflation?
Marginally, a little bit. But, as I read what some people are saying, as opposed to what they're doing with their money, by the way, but what some people are saying, it's not a fear that, inflation will overshoot the Fed's target by 50 basis points or something like that. It's some fear that the Fed's going to lose control of inflation because of this mountain of bank reserves that they've created and won't be able to withdraw. I just don't. It's not literally impossible, but I don't see a high likelihood of that.
Hey, guys, just remind everybody, Alan, remind everybody what the output gap is, because we're talking about it. I don't think everybody at home might know.
It's the gap between actual and potential GDP. You could also think of it as the unemployment gap. It's another way to measure the same concept. The difference between the high unemployment rate we have now and the unemployment rate we would have at full employment.
All right. So, I'm sorry, Kathleen, do you want to jump in?
Go ahead.
There are folks, though, Alan, out there that are looking at the rise that we've seen in commodity prices, oil in particular. And I know you said if you look at core CPI, different story. But, can we just disregard that? That doesn't say to you that we are maybe sooner rather than later have some concerns about inflation?
I don't think so. First of all, the only commodity price that really matters in terms of large magnitudes is the oil price, as you say. The others are in there, but they're small beer in the overall picture. And by the way, much more indicators of the strength or weakness of the world economy on the real side rather than of inflation. That's a fallacy about commodity prices that just won't go away. Oil is big enough to actually move the overall price index around when it moves by large amounts. And that's the reason that the last 12 months CPI headline was minus, I think, 1.3%. It was coming from oil. That's going to reverse. And that minus is going to turn back to a positive number.
All right. We got to take a break, Alan, but sit tight. We're going to come back and more. We are talking with Alan Blinder, economics professor at Princeton University, and our own Kathleen Hayes also on set with us. So we're going to take that break about 20 minutes after. When we come back, we're going to talk to Alan more about his outlook, also get his thoughts on what we might hear from the Fed. Remember, they do have a meeting this week. We're back with Alan Blinder in 2 minutes' time. All right, back at 22 minutes after. I want to bring back Alan Blinder at Princeton University. And actually, Kathleen, I want to bring you right into it because you have more questions about inflation.
You know what it is? Because I want to keep hammering it just a little bit more, Alan, because it's a small move up. But when you look at the University of Michigan's Consumer Sentiment Survey, inflation expectations went up a little bit. For example, ask people, what do they expect inflation to be in a year? And in May, they said 2.8%. On average, they're looking at 3.1%. And I come back to say, everyone assumes we're going to have all this downward pressure on inflation. But what if people expect the Fed to succeed and get the economy going again? They don't think prices are going to fall. They see oil prices. Right. They see that huge budget deficit. They're going to be willing to pay higher prices, and that in itself is going to help push up inflation.
Well, to some extent, however, that's true. To some extent, you want inflationary expectations going up from the crazily low levels they reached in the winter. We had a point where the TIPS market was predicting the 5-year inflation rate to be zero. That means some negative years, some positive years, averaging to zero. The Fed's target, as you know, is somewhat below 2%. So that's a big miss. And correcting that is all to the good, not to the bad. That Michigan number that you cited has also gone up. but that's always been way high. You could look back decades, and that number is always high. There's a lot of public skepticism. I get it in my email. You probably do too. People don't believe the CPI. They think the government's lying to them, and there's more inflation. I think that gets reflected in those surveys.
Well, Alan, based on your outlook for inflation, we've got a story in the Bloomberg about how the biggest bond investors are buying protection from inflation. Specifically, they're buying TIPS, the guys at PIMCO, investors over at BlackRock. Based on your outlook, is that a wrong move in your view?
No, I think it's a perfectly sensible way and a very good way to hedge inflation risk. It seems to me that TIPS relative to regular bonds are sensibly priced right now. They're embodying a 1.6 to 1.9% inflation rate over the next 5 to 10 years, which I think is a reasonable expectation, but is not consistent with some of the inflation hysteria you hear from some people, as if we're going back to 5, 10, who knows, 15% inflation.
So, Alan, let's move to the Federal Reserve policy statement on Wednesday. They only have 4 or 5 paragraphs, and the market expects them to signal whether they still see green shoots and explain the exit strategy. What can we reasonably expect to see? What words might they change that we should watch as telegraphing something important from the Fed?
Well, first of all, I don't think they want to telegraph anything because I don't think they're going to do anything. So I think you will see some upgrading in the economic outlook, the green shoots, if you will. Bernanke's been saying that for some time, and the data are making it look correct. You may see some further, well, you've already been seeing in the last few statements a sense in which the Fed's at least as worried about inflation that's too low than about inflation that's too high, and I think they can keep that. I think they'll still say that the rates are going to be near zero for an extended period. They might modify it, as Paul McCulley was suggesting, to make it a little bit clearer. I think it's actually pretty clear now, but a little bit clearer that it depends on economic conditions, not on turning the pages on a calendar.
Alan,
I'm not sure whoever thought the other.
Are we going to hear anything on an exit strategy in your view?
I don't think so. I think what the Fed should be doing is talking internally about an exit strategy now, but not be musing about it in public. Because as soon as they start musing about it in public, the market's going to start thinking it happens next Tuesday, and they better adjust asset prices. This is a ways off.
So how far off is the first rate hike? Do you agree with Paul McCulley that it's not till 2011? That seems like a long time.
That seems like way too long to me. I wouldn't be surprised if it comes in the in next winter, the winter of
2010.
2010, in January 2010 or something like that. That's not a guarantee, but it wouldn't surprise me.
All right, got to leave it on that note. Alan, thank you as always. Alan Blinder and our own Kathleen Hayes in studio.